Good morning and welcome to Power Breakfast in the Mumbai News Centre. I am Anisha Jain and with me is Nigel D'Souza. Well, Nigel, good morning. Yesterday we saw that slide in the last hour of trade and today nothing seems to be working for the bulls at all.
Well, morning Anisha. You know, the bulls, they'll not want to wake up today actually just looking at the screen. But if you want to look at one positive, it's that Brent crude prices are at around $69 per barrel. So let's hope that in fact, that could give some kind of support to our markets. Otherwise, sea of red. We'll talk about that and more. First up, we're going to run you through all the top stories this morning. The Asian markets, they have opened up in the red as the US markets tumble overnight. Apple leads the tech rout on Wall Street. And in the world of commodities, Brent crude prices slips to $69 on a per barrel mark.
In key earnings, Coal India Q2 profit meets estimates. Adjusted margins come in mostly in line. FSA sales a little higher than estimates, but e-auction sales volumes drop. Eicher delivers no surprises, no fireworks as well in its Q2 numbers because the revenues and margins in line with expectations.
And in earnings to watch out for, Sun Pharma's Q2 top-line growth is seen in low double digits. The margins are expected to remain steady at around 20 to around 22%. While for Tata Steel, the India EBITDA per ton and Europe EBITDA per ton are likely to see a big surge backed by higher global steel prices.
First signs of a thaw after the heated battle between the government and the RBI. Sources say Governor Urjit Patel met Prime Minister Modi on Friday. Both government and the central bank could soften their stance on key flashpoints at the RBI board meeting on the 19th of November.
And the battle for states kicks off with 18 constituencies in Chhattisgarh and Naxal-affected regions going to polls. Over 60% voter turnout recorded in the first phase of the assembly elections in this state. Well, first up, a check on the Asian markets. It's a sea of red across all those Asian markets on the back of the weak close that we saw on Wall Street overnight. The Nikkei, the Japanese index, that's down close to around 2.5% approximately. Now it's down close to around 3%. The dollar yen still holding above that 113.5 odd mark, but that's not enough to prevent it from that sort of a slide. 700 points lower on the Nikkei. And it's not just the, the Nikkei that we're talking about. The Kospi, that is down nearly around 1.5%. It had opened up with a cutoff around 1.5%, and now it's moved virtually to the low point of the day. So that as well is down close to around 2%. And the other couple of markets, both the Straits as well as the Taiwanese index, they had opened up with some cuts. And those markets as well, after the initial, red tick to kickstart trade, they in fact have moved to the low point of the day. So sea of red coming in from all those Asian markets, and the SGX Nifty suggesting after yesterday 100-point slide that we saw on the Nifty, maybe we'll see another 50-point downtick just to kickstart trade.
And all this actually because the US markets ended in the red with the Dow down about 600 points, Nasdaq down around 200 points and the S&P lower by almost 2%. Wall Street saw a big decline owing to sharp slide in Apple shares. Remember, Apple tanked by around 5% after Illuminton Holdings, which makes technology for the iPhone's face recognition function, cut its outlook for fiscal second quarter 2019. As a rise in the US dollar as well as the lingering worries about global trade, this also weighed on the investor sentiment, and that's the reason we saw that big slide in all the key indices in the US market. CNBC's Eric Shemi gets us a wrap of all that transpired on the Wall Street yesterday.
Stocks taking a big hit today. The Dow dropping over 600 points, the S&P losing 54, and the Nasdaq losing over 200. Apple shares sliding after one of its facial recognition suppliers, Lumentum, cut its outlook, citing reduced shipment requests from, quote, a large customer. That customer is widely believed to be Apple. The announcement adding to speculation that Apple is reducing production of its latest iPhones. SAP will buy Qualtrics for $8 billion, snapping up the survey software company just before its planned IPO. The all-cash deal has been approved by the boards of both companies and by Qualtrics shareholders. The deal is SAP's second largest ever after their $8.3 billion deal to buy travel and expense software company Concur in 2014. GE shares slipping below $8 for the first time since 2009 after CEO Larry Culp told CNBC's David Faber that he feels urgency to reduce the company's leverage and will sell assets to raise cash. Culp giving 3 examples of how the company is freeing up cash: a possible IPO for GE's healthcare business, the sale of its transportation business, and the coming exit of the Baker Hughes oil field services business. That's the action from the U.S. market. Back to you in Mumbai.
It's a big slide coming in for the U.S. markets. In fact, on that note, let's hear out what global experts have to say about the road ahead for the U.S. market and the trade concerns going on between U.S. and China.
Markets are going to end the year higher than where they are today, and people are mostly focused on all these negatives, and what they're ignoring is there's a lot of other positives out there. You know, last week, for instance, where the markets moved down, one of the things that's worth looking at is there was no contagion into credit markets, right? BAA spreads actually tightened. There was very little Treasury market volatility, and the message to me is that this is really an equity-oriented problem. I look at the environment out there, and I think, you know, the markets are going to head higher for the rest of the year.
My single biggest worry is the trade situation. But even there, because this is something that Washington has under some control, irrespective of what happened in Congress, I am cautiously optimistic that within the next 3 to 6 months, we may see at least a thawing of those trade tensions.
Certainly the hopes are there that there will be a thaw, or a truce, if you will, in terms of these trade tensions between the U.S. and China. You know, my sense is that if this indeed is a long-term containment strategy on the part of the U.S., then I would probably fade any kumbaya moments, if you will, on trade, because I think this is a longer-term process.
All right, then turning our attention to the European markets, they ended in the red. That's amid the tech sell-off. Now, the DAX closed with a cut of around 1%. The CAC as well was down nearly around 1%, while the FTSE ended with a cut of around 0.7%. As the screen is telling you, the DAX was a big underperformer yesterday. That ended with a cut of around 1.5%. Now, the tech sector, that saw heavy declines. This after SAP was down close to around 5% on news of it buying Qualtrics in an all-cash deal. And clearly the market didn't like that one. So that, in fact, ended with a cut of around 5% approximately.
Okay, let's now shift focus to the world of currency because a lot of headlines coming in from there as well. In fact, the dollar index has softened from yesterday's 16-month rally around that 97.5 mark. The dollar's strength, however, has raised concerns among investors over its impact on earnings growth. The yen, meanwhile, also saw some weakening from levels around the previous session, though it is still strong versus the earlier 114 level that we had seen recently, but no respite really coming in from the dollar index because it is currently trading at that 97.6 mark.
Okay, then turning our attention to the world of commodities then. Crude oil prices failed to rally further on Saudi's announcement. Now, NYMEX crude prices topped off at around $61.2 per barrel, providing further encouragement to short-term bears, at least until the December 6th OPEC meeting. Now, Trump's tweet as well pushed oil prices lower. He says, and I quote, that in fact, hopefully, Saudi Arabia and the OPEC will not be cutting production. Oil prices should be much lower based on the current supply. Okay, all right. On that note, then I think we can get in some opinion coming in.
If you ask me which one is the over-dominating factor, it has to be supply. We're seeing the U.S. really producing more oil than it's ever produced oil. And we are also seeing that other countries are also ramping up production. So supply is certainly dominating demand. And by the way, when you look at the U.S. economy, 4.2% growth in the second quarter, 3.5%, you're not seeing a lack of demand on the part of the U.S. And even China, now they're ramping up stimulus, monetary policy. They're lowering interest rates. They're also doing more fiscal policy. That's going to mean more future.
The demand side for oil has been robust, but there's clearly some slowing, and then you have some short-term concerns about supply, and we're hearing, you know, all the news about OPEC. So, you know, oil's down about 20%, but commodities in general are down, and I do think China plays a large role. It's one of the key components that we try to figure out in terms of this puzzle for next year. We know we're in this holding pattern in the U.S. market this year. But next year, a few things have to come together. Commodities are a highly volatile asset class, so a 20% decline in oil is not the same as a 20% decline in the S&P 500, for instance.
Now, back home on the Lal Street, the bulls, they were on the retreat as a surge in crude oil prices in late trade yesterday. That's what really spooked sentiment a bit. And on the back of that, we had the Nifty as well as the Sensex. They ended lower with a cut of close to around 1%. The Nifty, in fact, failed to hold on to the 10,500 mark as well. The Sensex was down nearly around 500 points from the highs of the day. The mid-caps in the Nifty Bank, they as well ended with sharp cuts. Now, overnight, we have global cues that ain't the best because we have all those Asian markets that are trading with cuts. But the silver lining is that Brent crude prices have moved lower. Also, we'll be keeping an eye out on the dollar index because there is some strength that we're seeing out there. Anisha, stack up all the cues for us. How do you expect trade to pan out today?
Well, yes, as you mentioned, it is a weak cues globally that might just pressurize the Indian markets this morning. In fact, you talked about Asia. If you look at Nikkei, that one was down over 700 points at one point of time with a cut of around 3.4%. That one has recovered a tad bit from the low point, but is still sitting with a cut of around 700 points. Kospi is down about 2%. Let's pull up the other Asian markets as well, because the early rates from Hang Seng also suggested a cut of around 450 to 500 points, and that does not give very positive cues for the Indian markets as well, though to take heart from the fact that the SGX Nifty is just suggesting a cut of around 40 to 50 points. That's just 0.5%, though we did see a decline of around 100 points yesterday. But to start off the trade, it looks like we'll start below the 10,450 mark. And all of this actually because the US markets ended weak. Now, if you pull up the US markets, the Dow ended around 600 points lower. S&P 500 has gone back below its 200-day moving average, and Nasdaq has also fallen back into the correction territory. Deep cuts coming in there. S&P down about 2% and Nasdaq seeing a cut of almost 3%. What also really exaggerated the down move was the strong dollar rally that we have seen. So remember, the dollar is now back to the June 2017 level, and add to that the trade concerns. We saw a risk of sentiment really playing out, and that's why that big sell-off in the US markets. It was the tech stocks as well that came under a bit of pressure. Apple, we knew it was down about 5%, but Amazon as well has entered into a bear territory as it is 20% off its recent high. What also did not help the investor sentiment is a report that came in from Bloomberg which suggested that White House was circulating a draft report on auto tariffs, and that might include tariffs on auto companies as high as to the level of 25%, and that definitely did not aid sentiment at all. And as I was mentioning, look at the dollar index. It hit a high of 97.6. That's the highest level that we have seen since June 23, 2017. Does not augur too well for the rupee as well. Yesterday, we weakened a tad bit by around 40 paise. We had gone beyond that 73 mark, but we, by the end of the day, had retraced and ended at around that 72.9 mark. Crude, well, yes, as Nigel mentioned, that is the only saving grace because right now it's hovering around that 69.4 mark. And that also because Donald Trump, the president of the United States, tweeted, and he said that hopefully Saudi Arabia and OPEC will not be cutting oil production. Oil prices should be much lower based on supply. So a lot of cues actually coming in from the crude world, and the volatility is actually directly impacting your equities as well. And that correlation has been seen both in Dow as well as the Indian Nifty. As far as the domestic cues are concerned, well, the post-market earnings were really mixed, but separately, the other key talking point has been the RBI versus the government kind of issue, and there we are seeing some toying out because it seems that Urjit Patel, the RBI governor, met with the Prime Minister, and they have discussed some likely resolution in terms of the Basel III norms or the PCA framework. We'll discuss more on that, but Nigel, to begin with, it'll be the weak global cues really that dominate Mindspace, and we'll see a downtick of 40 to 50 points, it seems.
Absolutely. You know, the big question is, will that first downtick be bought into, or at some part of the day, will that get bought into? Or in fact, will the bears pile on the pressure and we see some selling pressure? So you've given us all the trade cues. What about stock specific? What are you looking at?
Well, I'll just run you through some of the key earnings that came in post-market hours yesterday. Let's start with Eicher Motors because that is not doing much to, improve that earnings downgrade thing that you were talking about yesterday, because Eicher Motors, the revenues and margins came in line. The profits were lower than estimates because they were hit by an exceptional loss as well. So no surprise coming in from Eicher Motor. Moving on to Jet Airways, where it reported a third consecutive quarter of loss. And keep in mind that the losses were higher than estimates of some of the analysts on the street. Of course, the weaker rupee and the higher crude oil prices did not really aid the earnings there. Coal India, as naturally we've been pointing out, the revenue was up around 23%, and the adjusted margins, if you look at that, came in at 21.2% versus a poll of around 20.6%, and also the valuations are supportive. So let's see how that one reacts. Nalco, good numbers coming in there as well. The revenue up around 24%, margins at 28%. But keep in mind that was because of strong alumina pricing. Let's see how the coming quarters shape up when it comes to the pricing as well. Aurobindo Pharma, the numbers are a tad bit better than estimates because the revenue was up around 7%. Yes, the profit declined on a year-on-year basis, but still the number at 611 crores was better than the street estimates. Jain Irrigation, the numbers are lower below street estimate. Yes, there is a solid profit growth of around 50%, but that is not what the street expected. So that might see a bit of red tick. Also, the margins have come under a bit of pressure in the agro-processing division. Shree Cement, the top line was a beat, though the profit was a miss owing to the ILFS exposure that they have accounted for. But other than that, the sale is up around 21% and the margin at 20% is better than estimates. And some weak results coming in from the banking space as well in terms of UCO Bank as well as Bank of India. There are a lot of results other than that in the mid-cap space as well, like Waytech, Babag, etc. But these are the key ones that we should keep our eyes on. Let's put the spotlight on some of the key earnings that were reported post-market hours yesterday, and Coal India tops our charts. So, Nigel, tell us, optically, in the first look, the numbers didn't look very enthusing, but if you look at the details, they're pretty much in line.
Yeah, that's right. You know, if you just pull up yesterday's intraday chart, not the last 1 month chart, you know, there was a whisper number that went around that Coal India's numbers are going to be very, very disappointing. And at first glance, if you looked at it, you'll say, well, those that appear to be the case, particularly on the margin front. To run you through first the top line, that was more or less in line at around 22,200 crores, more or less in line. That was back because offtake we already had, that was up by nearly around 4.5%. Now the blended realizations came in high by around 13 to around 14%, and also the other operating income, that's sale, you know, sale of scrap, etc. That as well jumped up by close to around, you know, that more than doubled on a year-on-year basis. Remember, it was coming off a very, very low base, so that's something that you should keep in mind. But if you're looking at the operating profit, and if you looked at it, you said, well, it came in at roughly around 3,900 crores approximately. So the margins appeared that it came in at around 17.6% approximately, in comparison to our estimates of around 20.5% approximately. But if you're looking at, you know, adjusting that number, first, you'll be looking at what was the employee cost. Employee cost was roughly around 8,900 crores. So that was something that the street was working with. But two factors played out here because of that margin miss. One was provisions came in much higher. Normally, you have a reversal of provisions and you net it off, and then you know that's the provision number. Now, what they're doing is they're giving you the gross provision number, and the reversal they are accounting for in the other income. So that was one reason why, in fact, it appeared the margins were a miss. And the second factor is the stripping activity. This is a non-cash expenditure that ballooned up to around 800 crores on a year-on-year basis. So adjusting for the stripping activity adjustment, then in fact the margins come in at around 21.2%, which is in line or a little bit better than what the street was working with. To give you the breakup between FSA sales as well as e-auction sales, the derived sales volumes, you know, came in higher from the FSA sales. We're deriving it because they haven't given it straight up front. We have done the math, and that's why, in fact, you know, FSA sales volume higher by around 1.5 million approximately. The street is working with a number of around 115 million tons. But e-auction sales volumes were a little disappointing. The volumes are disappointing because it came in at around 18 million tons. The street would have liked a number of around 22 to 23 million tons approximately. But the e-auction premium to FSA, that looked good, came in at around 98%. That's the best I've seen in the last 10 quarters approximately. And the profit number as well, more or less in line. The effective tax rate was higher, otherwise it would have been bang in line. What supports Coal India, Anisha, is valuations. You know, that's why Edelweiss, they have a buy rating, target price of around 325. They have also spotted out that the balance sheet has improved. And in comparison to the end of FY18, the cash balance has moved up by around 10% to around 55 rupees on a per share basis. That compares to around 50 rupees at the end of FY18.
Okay, Nigel, so that was about Coal India. The numbers look all right when you look at the details, the margins also, the adjusted margin coming in tad better than the street estimate. But Nigel, what is the expectation from Tata Steel, and tell us the geographical breakup that we should expect?
Yeah, for Tata Steel, Anisha, it's very, very important to look at the geographical breakup. First, let's just pull out the initial poll numbers up for you. Top line growth of around 23%, margin should expand to around 17.5%, and the profit number should come in at around 2,200 crores. If you're looking at these numbers and trying to judge whether it was good or bad, you'll not be able to do that because the geographical breakup is most important. Sales volumes already with us. So let's break it up now geographically. The India sales volumes, we have it. That's coming higher by around 3%. Importantly, the automotive and special products out there, the sales volume growth is around 17%, telling you they're focused on value-added products. The EBITDA per ton that we are working with is around 16,600 rupees on a per ton basis. That'll be higher by nearly 50% on a year-on-year basis. On a sequential basis, it'll be a downtick of around 800 to around 1,200 rupees per ton. Why are we going to see such a big jump in terms of EBITDA per ton? The volumes are a little higher, the realizations are much higher. And remember, for Tata Steel, they are backward integrated to some extent with regard to coking coal, around 35-40%. They're getting it from their captive mines, and iron ore, all their requirement they get from their captive mines. Shifting focus to Europe, there's a bit of a degrowth in terms of volumes. The management has said that there was a shutdown out there, so that's why, in fact, there is that degrowth. So in terms of Europe, EBITDA per ton on a year-on-year basis, it looks spectacular. It'll come in high by around 50%. On a sequential basis, though, there will be some contraction primarily because iron ore costs as well as coking costs have gone up. And that's what affects them because they're not integrated out there. So keep that in mind. Southeast Asia, we have the sales volumes, very small part of the business, a bit of a degrowth as well over there. Over there as well, we had an annual, shutdown out there. So 3 segments are done. Bhushan Steel, we already have their numbers out there. That was a tad bit better. So that's what will support the consolidated EBITDA number. 6:30 is when, you have the press conference. We'll wait by for these set of numbers. What a busy day for me, Anisha.
Well, yes, it looks like a long day given the press conference is at 6:30 p.m. for Tata Steel. But those were the key expectations from that particular company. But it is time now for a quick break on this.
PricewaterhouseCoopers study reveals that online digital content market in India is worth around $400 million and is poised to grow more. My colleague Jude Sanet caught up with the CEO and co-founder of Netflix, Reed Hastings. Let's hear out what he had to say about Amazon Prime and the competition landscape in India's online content market.
There's been so much talk back in India about the need to set up a pre-screening committee to actually monitor the nature and content of digital content that goes on Netflix or any other streaming portal for that matter. Given the fact that this is by definition over-the-top digital content, it does not have to be regulated. It hasn't quite been regulated up until date. Does the possibility of regulation in the future, does that upset the way you do business in India?
Many countries around the world have tight regulation on broadcast because it's pushed into everybody's home. Right. But on the internet, each customer gets to decide what they want to do on YouTube, on Netflix, on many other sites, on Hotstar. And so the customer's in control. And then we allow many parental controls. So you can block shows for your kids, so you can set maturity levels.
Absolutely.
No advertising on Netflix. So the government may eventually have concerns about the open internet, but Netflix is the least concerning of the internet.
Right. So you feel the government has no reason to perhaps interfere as far as this is concerned, over-the-top content?
Well, each government gets to make its own choices. It's not for me to decide. Right. But it's really about the internet and what's going to happen there. And then we're, a very safe, small part of the internet because, again, we don't have any advertising. We have parental controls. So really, the regulation is around, some of the dark corners of the internet.
Right. Reports have emerged in the last few weeks back in India that Netflix is currently considering lowering prices as far as subscription is concerned in India. For a long time, you were very happy with your prices. You didn't see the need for change. Was that decision, that consideration, rather a direct result and function of growing competition back home?
Netflix is so inexpensive. It's only 500 rupees a month.
That's $8, right?
It's 2 movie tickets, right?
Sure.
And that's for a whole month. So we're very happy with the pricing, and our Indian members are, we've got 3 tiers, 500, 650, and 800.
Right.
And the bottom tier is not the most successful. So there's no pricing issue with Netflix.
So you are not reconsidering lowering prices at all?
No, what got announced is that we're testing in some other countries, not in India.
Not in India.
Some smaller plans.
All right.
But, really the focus is not so much on the pricing, it's on what's the content that you really want to see.
Right. And yet your competitors back in India have far less, tariffs in terms of...
Most of them are free.
Absolutely.
Hotstar is free, YouTube is free.
Sure.
So,
but even the paid models have much lesser. It's only 160 rupees, Amazon Prime $1,000 for an entire year. So are you happy then catering to a certain premium level in terms of viewership?
Well, we're more like movies. You know, when you think about movies in India, it's usually 200 and 220 rupees.
Yeah.
So we're those kinds of production values, and you can watch, you know, 10, 20 movies in a month. So really, that's the focus, is to be more premium, no advertising in that way.
Right. Amazon Prime, of course, recently announced 2,000 crore investment, both in acquiring Bollywood titles and making original content of its own. And today, of course, you've announced this blitzkrieg of Indian titles, Netflix originals with your origins in India. Is the competition well and truly heating up? And what does this change, really, in the way the Netflix does business in India?
You know, when you think about Hotstar, when you think about all of linear television, Amazon, it's great for creators. There's so many opportunities to be a young writer and get discovered now. So, and the success is not only in India, it's also with this content around the world. Sacred Games has been very successful throughout the world. So, you know, we just see that the internet is unlocking this human creativity. And so, sure, you can think of it as a big battle, but you can also think of it as many, many choices for a customer.
So there's place for everyone. Is that what you're saying?
Absolutely. And we've seen this in the U.S. Amazon is huge in the United States. And
That's quite magnanimous of you.
And so is Netflix. Well, look, I use Amazon Prime, you know, every week.
You do?
Absolutely. So, you know, it's a great service.
Okay, let's shift back to earnings then. And Auto Pharma came out with its set of numbers. Ekta, tell us, how were those numbers?
Well, actually, morning, Nigel. You know, a good set of numbers which actually came in for Aurobindo. So the revenue was up around 7% to 4,751 odd crores, and this is versus estimates of a flat quarter on a year-on-year basis. Now, the reason why the the revenue was higher was primarily because of the US business, which was up around 12% Q-on-Q to $318 million. We also had the ARV, or the antiretroviral business, which is basically one of the businesses which declined significantly for the likes of Cipla. Strides also was weak in it. But Aurobindo has actually gone up around 17.6% and 56.8% Q-on-Q in the antiretroviral business, which is basically global tenders for anti-malarial, anti-HIV drugs. Also, just want to point out that growth markets also did well, so up around 26% for that. Margins came in line with estimates at 20-21%, so that was in line. And the profit decline was also because of an exceptional outflow. But the way to look at the profit was because of, the street was expecting a sub 600 figure. It's come in above 600 crores, so that would be a positive for Aurobindo. The conference call is at 8:30 a.m., so the market will be reacting to the management commentary along with the numbers today.
Okay, all right. So that's Auto Pharma that already came out with a set of numbers. But Sun Pharma and Glenmark, they'll be reporting numbers today. Ekta, tell us, what do we expect out there? Let's go with Sun Pharma first, since it's part of the Nifty.
Well, you know, for Sun Pharma, it's not supposed to be a bad quarter this time. In fact, I think the street expectations are that there will be a growth on a year-on-year basis, which will be led by basically a couple of their drug launches in the US. Now, remember that they've had Yonza, which is from the specialty pipeline, which they've launched in the US markets, plus they have the likes of Glumetza, etc. So a lot of these drugs should contribute to the US business. So revenue is expected to grow 17% odd. Margins are expected to come in at around 21% for Sun Pharma this quarter, with a profit growth of around 14% odd. Now, remember that Taro has already released its Q2 numbers. So we have a sense that Taro actually did better than expectations. So Taro should contribute positively to the US business. Overall, commentary would be obviously very important for Sun Pharma because in terms of what's happening with the Halol facility, as well as what's happening with the US pipeline, specialty products, etc. Halol, I just want to mention that there was expected to be a re-inspection, a CGMP regular re-inspection, so maybe more commentary on that.
Glenmark, what do we expect out there, Ekta?
Glenmark, watch for the US markets, because the US has in fact declined year-on-year for the past 4 quarters for Glenmark. So the decline in the US market is due to high pricing pressure, a high base due to cholesterol drug Zetia. So these are the key reasons. And Q1 FY19, US was down 32.6% year-on-year. So that particular trend will be watched out very closely. Overall, revenue up 10%, margin 16.5%, profit up 6.1%. Q2 FY18, India was up 5.3% only. So let's see whether or not, what kind of trend sustains post the GST restocking for Glenmark.
All right, Ekta, thanks so much for giving us all those previews on pharma, and take care of your health as well. We'll wait by for those set of numbers today. We'll slip into a short break though. Up next, it's a double cheer for the economy. Retail inflation softens as industrial output remains stable.
Well, first signs of a thaw after the heated battle between the government and the RBI over the last few days. Sources tell us that RBI Governor Urjit Patel met Prime Minister Narendra Modi on Friday, and there could be some give and take between both the parties at the crucial board meeting scheduled for the 19th of this month. Lata Venkatesh, who broke this story last night, first on CNBC TV 18, joins us now with all the details. Lata, good morning. Tell us what you're picking up.
Well, this was absolutely the most important story over the last month or so, after we heard of this serious rift between government and RBI and, consultations under Section 7 of the Reserve Bank, which has never been used before. After all that disagreement and, open tweets and fights between the two, the news that we get is very important. Governor Urjit Patel flew down on Friday to meet the PM, and thereafter, now no one of course is privy to what talks happened over there, but thereafter some rapprochement appears to be in order. It looks like both sides are trying to look at middle ground. We must have already heard of statements that for the RBI capital, the government will look for a framework. It's not the capital itself that they are asking. They look for a framework to decide dividends. So the give from RBI is going to be on the prompt corrective actions application. Will it apply to that? I don't think they're going to loosen the norms itself. The discussion appears to be some of the banks which are anyway down to 7% NPA, net NPA, or 6.5% net NPA. The RBI's filter is 6% net NPA. So they'll remove those who have shown seminal improvement to come towards that 6% mark. As well, they have not put PNB under a PCA, although it ticks all the boxes. So even that is a bit of a concession that the Reserve Bank has done. There will also be some quick taking out of PCA those banks that have merged into larger entities like IDBI or Dena Bank, because they're going to become part of entities which are not PCA or which are very healthy. The other concession could be in terms of a package, a restructuring package, or some kind of forbearance for the SME sector, which has been hit by both GST and DEMO. And on the government side, of course, capital perhaps will go to a committee which will decide, how the framework of dividend and surpluses should be decided. They are definitely not going to insist on a line of credit for NBFCs. That was something the Reserve Bank was totally opposed to. So both sides are going to, looks like, are working towards a give and take.
All right, Lata, thanks so much for that. So we'll keep an eye out on that. But stay with us, Lata. Tell us about the big macro data that came out yesterday. Inflation continues to slow down. It was below the RBI's target, as well as the industrial output data looked pretty good.
Yeah, both had a little bit of cheer, though, one person's cheer is another person's despair. There has been a fairly steep fall in the inflation number to 3.3%. But look at the food inflation. That's the tragic part. Much of the disinflation is coming because of the seminal fall in food prices. Now, this is not a lower pace of growth of prices. This is a contraction of prices, and that affects a large part. About 50% of the economy is employed in agriculture, and therefore, a severe disinflation can hurt. But for the MPC, the headline inflation at 3.3 indicates that there's no question of a rate hike at all. As well, I just want to point out that the core inflation number is still coming in at about 6.1%. So that's a bit of a bother, but the MPC is guided by headline. IIP number, again, important because it's coming in at 4.5 versus expectations of 4.1. And some elements of the IIP, like infrastructure, grew at 8%, a very good number. And other elements like capital goods growing at about 7%. Basically, the number is better than what the market expected. 5.8%. The capital goods number last month was 5%. So all round, the IIP number are a bit of a cheer. I don't think it'll bother much because the results of all these capital goods companies have already come. So there's nothing much that the market will take away from the IIP numbers.
Okay, but nonetheless, a positive macro cue to start of the day, and given the negativity or the weak cues coming in from the global markets, that might just support the markets a tad bit. But from the macros, let's move back to micros. In fact, let's talk about some earnings now. Eicher Motors came out with earnings yesterday. While the margins and revenue were in line with the expectations, profits came in lower than what the street was expecting. Sonia is here with the key highlights. Sonia, good morning. Take it away.
Hi, good morning. Thanks for that. Well, for Eicher Motors, there were no surprises really. Growth has slowed down as we were expecting because of the Kerala floods and the strike at the Orgadam plant, and the earnings have been impacted because of that. So as you rightly pointed out, the revenues were in line with expectations. It's an 11% growth. Volumes have slowed down for them. The Royal Enfield volumes have gone up just 3.6% year on year compared to a 21% growth that we saw last quarter. And that's the reason the margins have also been under a bit of pressure. Higher launch costs has resulted in the other expenses going up 36% year on year, and that has impacted their margins. Margins have fallen to 30.5% versus 31.8% same time last year. The profits are flat versus an expectation of a growth. That's because they incurred an exceptional loss of almost 20 crores due to an impairment loss in the value of investments in the Eicher Polaris JV. Now, more importantly, at the conference call, they did scale down their production estimates for the full year. The management now expects the FY19 production to be at 925,000, lower than the earlier guidance of 950,000, and a lot of brokerages have scaled down their earnings estimates as well. Jefferies says it's an in-line performance, but there are near-term headwinds. They've cut their volume estimates to reflect the supply and demand issues. They've reduced the target price to 27,100 versus 34,700 earlier. Macquarie too has cut their target price to 30,000 versus 37,000 earlier. So yes, the numbers are in line, but growth clearly has slowed down and there could be some near-term headwinds. I expect the stock to be slightly under pressure today.
All right, so that's about Eicher Motors, Sonia. But what about Jet Airways? The numbers were pretty bad, but the management is talking about some cost-cutting efforts going ahead as well.
Oh yes, but the most important thing really is funding, and none of that has come through. The management, of course, has said that they continue to engage with financial stakeholders for funding needs, but there's no fund infusion at the moment. I think that would disappoint the street. Also, the numbers are looking really bad, worse than what the street was anticipating. Third consecutive quarter of losses. In fact, it's an EBITDA loss as well that they have reported of 1,260 odd crores was the profit earlier round. Weaker rupee, higher fuel prices have hit earnings this time, and the revenue growth has also slowed down because of seasonal weakness. So it's been just a 9.5% single-digit revenue growth that we've seen on a year-on-year basis. Now, if you look at the Q2 numbers, they were adversely impacted because of a 440 crore forex hit because of the weaker rupee and an 800 crore impact due to higher fuel prices. All of this put together dragged down the bottom line, and they reported a net loss of almost 1,300 crores this time around. The other key internal to track is the cost per seat kilometer, and that continues to be very elevated. It is the highest in the industry and continues to stay at about 4.75 rupees per kilometer, much higher than the revenue per seat kilometer, because of which they're trading, they're sitting on losses. So expect the stock to be in the red.
Okay, Sonia, thank you so much for that, but we'll not let you go on that because it seems like trouble's mounting for cash-strapped. In fact, we want to know the numbers that are expected from Ashok Leyland this time as well. Sonia, tell us, what is the street expecting?
Well, Anisha, for Ashok Leyland, the numbers are expected to be good this time around. The CV cycle, the CV industry is in an upcycle. The numbers have been very good. The volume growth, in fact, for Ashok Leyland remains very strong despite the uncertainty regarding the axle norm changes. So this time we saw 27% year-on-year volume growth this time. Medium and heavy commercial volumes were up 22%. Light commercial vehicle volumes were up 40% this time. And overall, in the first half of the year, the volumes have gone up 35%. Also, discounts have come off. In fact, they're flat on a quarter-on-quarter basis. So we're expecting the realizations to also be largely stable. The margins will expand because of operating leverage and strong volume growth. So overall, the numbers, a revenue growth of 28% at 7,761 crores, and EBITDA growth of 40% is what we're looking at. The margins to expand about 90 basis points year-on-year at 11%, and a profit growth of 58%. In fact, the stock has outperformed the BSE Auto Index this year. It's flat for the year, while the the auto index itself is down 22%, I guess reflecting the good numbers that, the company might post.
Okay, all right, Sonia. Thanks so much for that. Well, we'll slip into a short break. You come back, we'll tell you all the cues coming in from the derivatives market. Stay with us.
Well, a lot of headlines coming in from the world of crude, and Manisha Gupta, as always, joins us with the update. Manisha, good morning. Tell us what's happening.
Oh, well, yes. Yesterday we were all reacting to the Saudi Arabia statements where they said that they are looking to cut 500,000 barrels per day in the month of December, and that OPEC overall should cut 1 million barrels from the October levels. But the latest decline yet again has come in from crude from the U.S. President's tweet, where he says that the demand is well balanced and that the Saudi Arabia and OPEC shouldn't actually cut any output here, and the prices should be on the lower side, and that's pulled the prices down yet again. As we've been discussing, that the crude oil prices are not looking to a recovery. It's not going to be a U-turn from here because demand is going to be a bit of a concern and the supplies have been increasing. So at best, what we will see is consolidation coming in for the crude oil prices now at these current levels, after we have seen a 20% decline in prices in the last month itself. So it is perhaps going to be a $2 down, $4 up kind of a range continuing for the crude oil prices by the time we end this year. What is going to be important really is the currency play, because we have seen the US dollar index continue to gain up. It's trading at a June 2017 highs right now. It has been holding around that 97.5 kind of levels for last couple of sessions. And the equity market sell-off and the kind of Fed interest rate talk that the markets are looking at, the US dollar and the treasuries yet again are a commodity for safe haven, and that is exactly what we've seen. So even as the pound sterling, the Swiss franc, the euro have continued to decline, the US dollar continues to be on the stronger side, and that will weigh on many of these dollar-denominated commodities as we've seen. So not just crude, but if you look at the metal space, that also has opened slightly on the weaker side today.
Okay, all right. Thanks so much for that, Manisha. Well, as promised, let's hop across to Mangalam. He's standing by to tell us all the cues that are coming in from the derivatives market. Hey, Mangalam, morning.
Good morning, Nigel. Rather interesting cues coming in from the flows perspective. The first things first, for the second day in a row, we are seeing some cash purchase come by from the FIIs. The big question, of course, is this a trend reversal or not, will be answered much later. We have to watch out for more data points. However, remember the last two trading sessions, the Nifty did not do too well, but the FIIs still went ahead and bought. The domestic institutional investors, however, have been selling for 2 days in a row. The index futures space, yes, there was a mild sell number of sub 200 crores in the index futures, and there was an equal amount, almost equal amount of longs as well as shorts added by the FIIs. So the jury's still out on which way the market will move given the weakness in the global markets, but we do have our own positives. Now to the most important data point, the index option space. Out there, the FIIs added long puts and wrote some short calls. And this is important because the previous trading session, the FIIs added long calls and wrote short puts. That did not get some follow through on the upside. So we saw some unwinding. Can that happen today? Will there be follow through on the downside or no is the big question, because if there isn't, then there could be some short covering. Interesting call action at 10,600 as well as 10,700. Keep an eye out on a couple of stocks. Adani Power enters the F&O ban. Most of last series, the stock was in F&O ban, has now come into F&O ban again. We saw some fresh longs being added on Wockhardt after the big move that we saw yesterday, and some short positions added on DCB Bank. The open interest out there spiked by about 11%.
Okay, Mangalam, thank you so much for getting us all those cues, but let's move on. The government has complied with the Supreme Court's order and submitted details of the decision-making process that went into the Rafale fighter jet deal. Now, remember, just 2 weeks back, the Apex Court had ordered the government to reveal these details to the three petitioners in the case, that is, former Union Ministers Yashwant Sinha and Arun Shourie, along with senior lawyer Prashant Bhushan. Now, in its submission, the government claims that it negotiated the deal for over a year and followed the defense procurement policy of 2013. But many questions remain unanswered. Rituparna Bhuyan is here with a few of them. Rituparna, over to you.
Well, several interesting observations as far as this submission is concerned. For example, Supreme Court has been told by the government that the negotiations between India and France began in May 2015 and lasted till April 2016. And at the same time, the process to withdraw the RFP for the MMRCA deal, the 126 aircraft MMRCA deal, that was started in March 2015. So why did the government ink an MOU for the same aircraft at a time when it was withdrawing from a deal and for the same aircraft. That is one. Secondly, as far as the services qualitative requirements or the user requirements are concerned, the government has told the Supreme Court that the SQR for the 36 aircraft deal is the same as the 126 aircraft MMRCA deal. Now, the question then comes to our mind is, can you have the same SQR for both the 126 aircraft deal and a 36 aircraft deal? Because Dassault's chairman, CEO, is on record to us saying that both these deals are different. So can you have the same SQR for the same aircraft as far as this deal is concerned? Also, if you look at the timeline that the government submitted, it says that the DAC approval for the 36 aircraft deal was given on May 13, 2015, while the final deal was signed on September 23, 2016. DPP states that you need a minimum of 92 weeks for single vendor in a single vendor case like this, while this 36 aircraft deal was signed as far as from the acceptance of necessity to the signing of deal, the period that was that we calculated was 71 weeks and 2 days. Last but not the least, if the government is saying that it's a better deal, why not then apply it to the entire 126 aircraft requirement that the Indian Air Force had initially proposed? Why only limit it to just 36 aircrafts or just 2 squadrons? With that, it's back to you.
Well, on that note, then we'll wrap up on Power Breakfast. You stay with us. Bazaar Morning Call comes up next.